You're about to drop $5,000 on a stock. But here's the big question. Are you paying 50 bucks for something worth 10 or getting a $100 bill for 20? Most investors get this totally wrong. Here's how to never be one of them. The price to earnings ratio, or PE ratio, is Wall Street's secret weapon for finding overpriced junk and hidden gems. But a 2024 Morningstar study found that 68% of everyday investors either skip it completely or use it wrong. I'm breaking down exactly what this number tells you, how to use it without getting burned, and the biggest mistakes even smart investors make. Let's jump in. The PE ratio answers one simple question. How much am I paying for each dollar this company makes? Here's the math. Stock price divided by earnings. Per share equals PE ratio. Real example. Tesla's stock costs $250. They made $5 per share last year. That's a PE of 50. What does that mean? You're paying $50 for every $1 Tesla makes each year. If their profit stayed the same forever, you'd wait 50 years to get your money back. Now, before you freak out, that's not always bad. Here's why. Think of PE like buying a house to rent out. High PE, 20 or more. You're paying top dollar because everyone thinks it'll grow fast. It's like buying a house where Amazon just said they're building a new office nearby. Low PE, under 15. Either you found a deal, or there's something wrong that nobody's saying out loud. Negative PE, the company's losing money. That's it. But here's the catch. You need context. A PE of 30 might be way too expensive in one business type, but dirt cheap in another. Recent numbers from FactSet show the S&P 500's average PE sits around 18 to 20. But check out these differences. Tech companies, average PE of 35 to 40. Why? AI, software that can grow huge, crazy fast growth. Power companies, average PE of 12 to 15. They grow slow, but make steady cash. New drug companies, often no PE at all. They're not making money yet, just spending cash on testing new drugs. Here's a real comparison. Picture two drink companies. Drink Co. Stock costs $60, makes $6 per share. PE of 10. Buzz Bev. Stock costs $90, makes $6 per share. PE of 15. If the average for drink companies is 12, Drinko looks cheap. But dig deeper. Maybe BuzzBev just launched an energy drink that Gen Z kids love. That higher PE might make total sense. Never judge PE by itself. Always compare it to similar companies. Here's where it gets useful. There are two types, trailing PE, based on what the company actually made last year. Real numbers, forward PE, based on what experts think they'll make next year. Smart guesses. Example, SolarTech stock costs $100. Last year they made $5 per share, trailing PE of 20. Experts think next year they'll make $10 per share. Forward, PE of 10. That dropping forward PE means growth is coming. But remember, Bloomberg says experts are wrong 40% of the time. If the forward PE is higher than trailing, watch out. It means profits are expected to drop. Here's where people mess up. Mistake 1. Thinking low, PE always means cheap. Sometimes it means everyone's selling fast for a reason. Mistake 2. Forgetting about debt. A company with a PE of 10 but owing $10 billion isn't really a bargain. Mistake 3. Comparing totally different businesses. Never compare a tech startup's PE to a power company's. Mistake 4. Using only PE. Smart money also checks debt levels, cash flow, and how fast sales are growing. Now, here's the question everyone asks. If I have a company with a low PE but steady profits, versus a company with crazy fast growth but an expensive PE, which one should I buy? This is where 90% of investors pick wrong. Let me show you the answer. Meet the PEG ratio, price to earnings to growth. This is what famous investor Peter Lynch used to build one of history's best funds. Lynch's rule was easy. If the PE number equals the growth speed, the stock is fairly priced. Here's the formula. PE ratio divided by yearly growth rate equals PEG ratio. Let's use a real example. Picture two companies. Company A, the cheap stock. Stock price, $28. Makes $5 per share. PE of only 5.6. Grows 7% each year. Company B, the growth stock. Stock price, $58. Makes $2.15 per share. PE of 27. Grows 50% each year. At first look, Company A seems like the obvious winner, right? PE of 5.6 versus 27. Easy choice. But watch what happens when we do the PEG math. Company A, PE of 5.6 divided by 7% growth equals a PEG of 0.84. Company B, PE of 27 divided by 50% growth equals a PEG of 0.54. Wait, the expensive growth stock is actually the better deal when you add in growth. Here's how to read PEG numbers. PEG below 1 might be underpriced. The market hasn't caught on to the growth yet. PEG around 1 to 2. Fair price. You're paying what the growth is worth. PEG above 2 might be overpriced. You're paying extra that growth might not back up. But here's what most people miss. A stock with a huge PE can still be reasonable if it's growing fast enough. For example, a tech startup with a PE of 60 sounds insane. But if profits are growing at 80% each year, that's a PEG of 0.75. That's actually cheap. Meanwhile, a power company with a PE of 12 and 3% growth has a PEG of 4. That's expensive, even though the PE looks low. So, which should you buy? Here's the plan. Step 1. Calculate both PEGs. If the low PE stock has a PEG above 2 and the fast growth stock has a PEG below 1, the growth stock is probably the better value. Step 2. Make sure the growth is real. Look into why they think it'll grow. Is it backed by new products or bigger markets? Are competitors a threat? A company saying 50% growth with no clear plan is a red flag. Step 3. Compare within the same business type. Fast growth businesses like tech often have higher PEGs because investors expect more. A PEG of 1.5 might be expensive for a power company, but cheap for a drug company. Step 4. Don't skip other stuff. Check how much debt they have, if they're making real cash, and if they have advantages over competitors. Let me give you a real situation. It's 2024. You're picking between two stocks. Stock 1, a boring soap company. PE of 10, grows 5%. PEG of 2, pays you cash dividends. Stock 2, an AI software company. PE of 40, grows 60%. PEG of 0.67, no dividends. The math says the AI company is the better value. But before you buy, ask, do I believe 60% growth will last? What if AI rules slow things down? Can this company turn growth into actual profits, or are they just burning cash? If you trust the growth story, the high PE makes sense. If you're not sure, the low PE dividend stock might be safer, even with the worse PEG. Bottom line, never pick based on PE alone. The PEG ratio makes it fair to compare cheap stocks and growth stocks by showing what you're really paying for each bit of growth. A low PE with no growth is a trap. A high PE with fast growth can be a steal. The PEG ratio shows you which is which. Now you know how to compare any two stocks.